Hi everybody, and welcome back to video number 6 in chapter 14. And when we left off, we were looking at stock splits as part of dividend policy. And the first bullet point in my experience is what we would use most of the time as to why we would do a stock split. It reduces the market value of the shares. It puts the shares of stock in a more affordable range. I can go into that in a little more depth in our tutoring session if you're interested. Okay, there's no entry recorded for a stock split. It decreases the par value and increases the number of shares. So, again, stockholders' equity is not affected by a stock split. As you see here, 150,000 and 150,000. The number of shares goes from 1,000 shares at $100 to 2,000 shares at $50, representing the same $100,000 when we have a 2-for-1 split. Okay. A stock split and a stock dividend are differentiated here. A large stock dividend is more than 20 to 25% of the number of shares previously outstanding, which it was in the last slide. It has the same effect on the market price as a stock split would, and the par value is transferred from retained earnings to capital stock. Okay. So let's look at a summary of that. Here, we've declared a cash dividend. It decreases retained earnings. Naturally, stockholders' equity and working capital are decreased. Again, working capital is current assets minus current liabilities, and the current asset cash is going down. Okay, so when we actually pay that cash dividend, our total assets will decrease here. Now, a small stock dividend, again, in summary, decreases retained earnings, but increases capital stock and additional paid-in capital, and the number of shares outstanding increase. With a large stock dividend, the retained earnings is decreased and capital stock is increased, but additional paid-in capital is not affected, but the number of shares outstanding is increased. With a stock split, none of the retained earnings, capital stock, etc. are affected, only the number of shares outstanding. Okay. Now, if we take a look at the Bronson Company here, it had the following dividend transactions. It has 2 million outstanding common shares with a $10 par value. So under Alpha here, they declare a cash dividend of $1 per share on its 2 million outstanding common shares at $10 par value. The dividend was declared on August 1, 2025, payable September 9th to all stockholders of record August 15th. Okay, let's look at that journal entry. And it's small print here, but the entries for that is going to be, we're going to debit retained earnings. That's going to be the 2 million shares times $1, and credit dividends payable. Okay, date of record, we do nothing. And then finally, when we actually pay that, we're going to debit dividends payable and credit cash for $2 million on September 9th. Now, under Bravo here, Bronson owns shares of Coal Corporation stock. At December 31, 2024, the securities were carried in, little typo there, in Coal's accounting records at their cost of $875,000, which equals their fair value. On September 21, 2025, almost 9 months later, when the fair value of the securities was $1.2 million, Cole declared a property dividend, whereby the Cole securities are distributed on October 23rd, 2025, to the stockholders of record on October 8th, 2025. So let's look at that one. Here, we're going to debit, just like we did in the couple of slides ago, the equity investments. We're going to show the gain on the investment here, $325,000, and retained earnings then will debit for $1.2 million, and credit property dividends payable for $1.2 million. Then no entry for date of record, and then we'll debit property dividends payable to zero that out, and credit equity investments for $1.2 million. Now, for Charlie here, on December 31, 2025, Bronson declares a 5% stock dividend when the fair value of the stock is $35 per share. Now, this is going to be a small stock dividend. So the distribution is December 20, 2025. So now what we do here for the small stock dividend, we'll debit retained earnings on December 1st and credit common stock dividends distributable here for $1 million, right? And then our paid in capital will be $2.5 million. That retained earnings of $3.5 million is $2 million times 5% times $35. And we use the fair value of the stock for small stock dividends once again. Then on December 20th, we will zero out the stock dividend distributable for $1 million and credit common stock. Now, lastly, Delta, we use the information in part Charlie here, but assume Bronson declared 100% stock dividend. Now that's a large stock dividend rather than the small stock dividend. So we do that differently, as you would know. We're going to debit retained earnings for $20 million. That's $2 million times the 10% par value. And we use par value for large stock dividends. So then we simply debit common stock dividend distributable to zero that out, and credit common stock. Okay, so how do we present and analyze stockholders' equity? Here, we show that for the Frost Company here. We present that. Here's our capital stock. We have some preferred stock, and common stock dividend distributable for 20,000 shares. So our total capital stock is $7.2 million. We have additional paid in capital. This is the excess over par for preferred and the excess overstated value for common stock, a total of $990,000. And so our total paid in capital is the sum of these $7.2 million and $990,000, or $8,190,000. Retained earnings, $4,360,000, and the total paid in capital and retained earnings, $12,550,000. We had some treasury stock, which we're subtracting here, and also an accumulated other comprehensive loss of $360,000, which leaves us with exactly $12 million in total stockholders' equity. Okay, restrictions. How do we disclose them on retained earnings? Restrictions are best disclosed by a note. Restrictions may be based on the retention of a certain retained earnings balance, the ability to maintain certain working capital requirements, additional borrowing, and other considerations, usually, in my experience, imposed by the bank. So here's Alberto Culver Company, and its note here, it says they have $200 million in revolving credit facility. The revolver, the term note, and the receivables agreement imposed restrictions on such items as total debt, working capital, dividend payments, treasury stock purchases, and interest expense. At year end, the company was in compliance with these arrangements, and $220 million of consolidated retained earnings was not restricted as to the payment of dividends. All right, so now if I look at a stockholder's equity in a columnar format, here we have our preferred stock, our common stock, dividend distributable, retained earnings, additional other comprehensive income, treasury stock, and finally we get down to the $12 million here in equity. So here's some key terminology: additional paid-in capital, accumulated other comprehensive income, preferred stock, common stock. Okay, and we went through that in the prior slides, how we got those numbers. So if we analyze equity, what we are going to look at primarily is three ratios that evaluate the company's profitability and long-term solvency. And when I talk about solvency, I'm talking about the likelihood that the company will remain in business. An insolvent company is a bankrupt company. So our three ratios, number one here, return on common stock equity. 2, the payout ratio. And 3, book value per share. So let's look at that. The formula for return on equity. Now you'll notice here that whenever we see return, it's usually going to be net income divided by something. And it is in this case. But this is return on common stockholders' equity. So we're going to back out preferred stock dividends. And then we'll divide by the average common stockholders' equity. And that is technically the weighted average common stockholders' equity. So the payout ratio, very easy to understand. This is like I take $100 and put it in the bank and I get 5% return on my money or something like that. Here we're taking the cash dividends that we pay to common stockholders and divide it by the net income available to common stockholders. Okay. Now, that's the payout ratio. So that's the percentage of my net income that's used to pay cash dividends. And then the book value per share, pretty easy to understand here. We take the common stockholders' equity, and divide it by the outstanding common shares. Not the issued or the authorized shares, but the outstanding common shares. That looks like a good place for us to stop this video. And when we return, we'll take a look at explaining the different types of preferred stock dividends and their effect on book value per share. Until that time, bye for now.